If you don't want to be completely reliant on stocks for income, the next alternative is to invest in credit. You could buy 20-year treasuries yielding 4% by investing in the $57 billion TLT fund. But look at this bumpy ride over the past year. If this was a roller coaster, it would be called the Vomit Comet. Sometimes boring is good, and for a calmer ride, there's short-term treasuries via funds like SGov, currently yielding 5.2%. But today, we'll look at a credit investment that offers a ride that's almost as calm, but yields close to 9%. I don't want to be all in on any asset class, including stocks. The current bull market feels optimistic, but stocks obviously don't go up every year, and that's where credit markets come in. The media focuses on bonds when it comes to credit markets, but there are other ways to access credit markets, including CLOs. Today we'll look at one particular CLO fund that's yielding around 9% and how it compares to some other CLO funds that pay more or less than 9%. The distribution history for today's fund, CLOZ, is good but not great. More consistency would be nice. These ups and downs remind me a bit of JEPI, J-E-P-I. However, if we look at the payouts on an annual basis, the last 2 years have actually been quite consistent. This distribution chart came from Snowball, which I also use to keep track of my income. I was trying to do that using my brokerage accounts, but they're not really designed for income investors. I entered the holdings from my 3 brokerages into Snowball, and now I can see the big picture in just a few seconds. I can rank my portfolio by current yield to see if there's something I want to sell. I can check the yield on cost, but most importantly, I can see a calendar that tells me how many dollars will arrive on any given day of the month. If you're watching this before December 4th, 2024, Snowball is running its Black Friday sale. If you're watching this after December 4th, no problemo, the link in the description will get you the sale price or the Armchair income discount, whichever is greater. The Panagram BBBB CLO ETF, ticker symbol CLOZ, is a fund that's focused on income, but also delivers a small but surprisingly steady amount of appreciation. It does this by investing in collateralized loan obligations, or CLOs. If those 3 letters remind you of the 2008 recession, it's probably because the housing bubble was caused by a similar sounding instrument, a collateralized debt obligation, or CDO. In fact, it was a particular type of CDO that caused that problem, the infamous mortgage-backed security, or MBS. The key difference is that mortgage-backed securities were pools of home loans, and those homes ended up being worth less than the loans against them. CLOs, the ones we're talking about today, are pools of loans to businesses, not houses, and they're secured by assets like inventory and equipment from the business. Both CLOs and mortgage-backed securities have their risks, but they're not the same thing, and CLOs did not cause the 2008 recession. Far from it. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider. Link in the description, it's free. Let's look briefly into how these CLOs work. Hundreds of business loans are pulled together into each CLO. The individual loans are put into categories based on risk. Those categories are called tranches, and each one has a different credit rating. AAA or AAA is the lowest risk and will pay the lowest yield. The unrated equity tranche, though, at the other end of the spectrum, is the highest risk and pays the highest yield. For some context, the ECC fund specializes in that equity tranche and yields a whopping 18% plus. I haven't reviewed that one. I have reviewed the EIC fund, and it's mostly focused on the BB tranche, plus a small amount of that high-risk equity tranche, and that one currently yields just over 15%. The fund we're looking at today, CLOZ, contains just over 40% BB tranche. That's the one that makes up most of EIC. What separates CLOZ from EIC is that it has no exposure to the riskiest equity tranche, and just over half the fund consists of the BBB tranche. The rest, less than 10%, is in cash. Note that loans rated BBB or above are considered investment grade. You can also buy funds with less risk than CLOZ, which we'll get to shortly. Taxes and fees are pretty straightforward. Tax treatment is ordinary income and the management fee is 0.50%. Apart from the yield, here's what I like about CLOZ. Let's start with the obvious benefit of this fund, which is low volatility. The loans in these CLOs are floating rate, so the price of CLOZ doesn't really change that much. We can see this clearly by comparing it to long-term treasuries represented here by the TLT fund. 20-year treasuries have far superior credit to CLOZ, but the price of 20-year treasuries bounces around because their coupon is fixed, and fixed for a long time. If you hold a 4% 20-year treasury and interest rates spike up to 5%, investors don't want to sit on that 4% for 20 years, so they dump those treasuries for a cheaper price. Here's a related question. Should an income investor care about price volatility? Well, not necessarily. You can just keep collecting your income and ignore price fluctuations. However, the advantage of holding a low volatility fund is that if the price only falls just a little bit while other funds are crashing, you can sell the low volatility fund and go shopping for bargain basement deals. The less obvious attribute for the CLOZ ETF is distribution coverage. In other words, do the loans in the CLOs produce enough revenue to comfortably cover the distributions? Let's go to the most recent annual financial statement. On page 12, the summary for the year ended August 31st, 2024 shows us that the total income generated was $2.61 per share. They also generated a capital gain of 50 cents for a total of $3.11. The total amount distributed to shareholders over that year period was $2.40. That means that the income alone was more than enough to cover the distributions, which is a good thing. The third attribute I like about CLOZ and CLOs in general is their very low default rate. This chart compares the default rate for CLOs to the default rate for corporate bonds. The purple line shows the default rate for junk bonds. These are below investment grade. The yellow line shows the default rate for all corporate bonds, junk and investment grade all mixed together. You can see it peaked at about 4% in the 2008 recession. The green line shows the default rate for all CLOs. It's close to zero. So why is that? The Standard & Poor's report explains it here. 75% of the corporate bond defaults in 2023 were rated CCC plus or below. Remember that credit rating chart I showed you earlier for CLOs? The CCC rating wasn't on there. These CLOs don't carry loans with credit ratings that low. Here are all the S&P credit ratings. The lowest credit rating in the CLOZ fund, though, is BB. Here are the risks and concerns I have about CLOZ. The first CLO fund that I reviewed, EIC, is a closed-end fund. That means the size of the fund is fixed. By contrast, ETFs like CLOZ are open, and that means each day they expand or contract based on the demand for their shares. If there was a panic in the market and investors dumped an ETF like this in large numbers, there is a risk that the CLO manager would be forced to sell some CLOs at a discount. The concept of this risk is that ETFs are more liquid than CLOs, and therefore, at the extreme, the CLOs would have to be sold at excessively low prices to find buyers. Now, the validity of this risk is hotly debated, and I haven't found a conclusive answer. It was posed to John Kim, the former CEO of Panagram, in a podcast interview that I listened to, and he said that there are still plenty of CLO buyers in distressed markets because the default rates are so low. It's something that I'll continue to look into. The advantage of floating rate loans is the fund's price stability, as we saw earlier. The disadvantage, though, is that when the Fed cuts rates, the income from these loans will also fall. It won't happen overnight because the loan interest rates are adjusted every 30 to 90 days, but it will follow the general trend of the Fed funds rate. For that reason, CLO funds may become less attractive if we return to a low rate environment. The obvious negative for CLOZ is its short history. It began back in January of 2023, which is not that long ago. We haven't seen how it holds up in a bear market. But we can look at two of the more popular CLO funds to see what happened during the bear market of 2022. JBBB holds CLOs with a credit rating of, BBB, so a higher rating than CLOZ's mix of BB and BBB. JAAA holds CLOs with, you probably guessed, the highest rating, AAA. In 2022, the S&P 500 fell down into the negative 20s and ended the year just short of a 20% loss. JBBB touched the negative 10% loss line a few times, but ended up at a negative 6.6% loss. And JAAA ended the year without a loss. Given that CLOs are rated slightly below JBBBs, I'm assuming it would have fared slightly worse than JBB and far better than the S&P 500. By the way, this is one thing I like about CLOs. You can use these credit ratings to get a sense of risk, then create your own blend to suit your risk tolerance. So an investor looking for less risk than me could buy mostly JAAA, some JBBB, and a touch of CLOZ to create a blended yield of, say, 8%. If you're interested in comparing CLOZ to JBB in more detail, this analysis by Juan de la Hoz on Seeking Alpha is worth reading. It's called JBBB versus CLOZ, which high-yield CLO ETF is best for income investors, which is right up my alley. I'll link it in the description. There are currently 8 articles on Seeking Alpha about CLOZ, plus the one I just mentioned. I read all of them to prepare for this video. If you only have time to read one article, which is probably the case, I think Juan's analysis is enough to get you up to speed on how CLOs work. As I mentioned before, I'm recording this while Black Friday sales are running. So if you want to buy something that can help you make more money instead of buying, say, a TV that's even bigger than your current TV, there's a link in the description for the sale on Seeking Alpha, and it ends December the 5th. After that, the link will still get you the Armchair income discount. There's not much to say about pricing for this one because it hardly changes. There's often a brief dip when the monthly distribution goes out, so if you wanted to book the highest yield, you could buy during that tiny little dip. As recently as 3 months ago, the market thought that the Fed was clearly on a path to systematically cut interest rates. That sentiment has shifted a bit, and now I'm hearing credible arguments for rates rising and other arguments for rates falling over the coming year. So I'm conceding that I don't know which way interest rates will go, and I don't think anyone actually does. My current plan is to hold some investments that benefit from rising rates and some that benefit from falling rates. In other words, a neutral stance. The CLOZ ETF will remain attractive if rates rise, remain flat, or fall slightly. I plan to start buying it within the next 30 days. I'm also open to buying maybe some JBBB. When that happens, I'll post updates in Armchair Insider. I'm still relatively new to CLOs, so CLOZ will just be my second purchase in the space. I'd like to hold a blend at various levels of risk and yield that averages closer to a 10% yield, and that's substantially lower than EIC's 15% yield, which is the last one that I bought. As my knowledge and understanding grows, I'll continue to add more CLO exposure. Speaking of EIC, if you'd like to learn how that fund generates a yield of 15%, click here. That wraps it up for this look at CLOZ. More Armchair Income coming soon. Armchair Income.